Welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is one of the best ways for you to exit highly appreciated assets, cryptocurrency businesses, real estate, primary homes. You can defer millions of dollars of tax, and so you can create and preserve more wealth, or help your clients and friends and family do the same. Hey, I'm your host, Brett Swarts. In each episode, I'm joined by some of the best real estate, wealth, financial, and business minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. Hey, I'm excited about our next guest. He is out of Canada, and he, for the first time, in a very long time, he realized that the adventure is a major part of his life. And he resides his practice with taking roads less traveled in the financial industry, including the use of technology, client experience processes, and including staff and overall business decisions. Outside of his practice of being like a financial advisor, he's a CFP, CLU, CIM, and CHS. He's never shy of experiencing something unique with his clients. From fishing to racing exotic cars, he's always trying to fit into something new and so much more. Please welcome to the show with me, Dustin Service. Dustin, how you doing?
Good, Brett. How are you? Thanks a lot for having me on the show. This is very exciting.
Absolutely. And for our clients who are getting to know you for the first time, by the way, we're talking about finding your spinning accelerator. That's finding your spinning accelerator. But before we go there, Dustin, tell us a little bit more about your story and your current focus.
Sure. So I would probably start with, again, I've been in the finance industry for 18 years. I've got a background in civil engineering, but I didn't really find that very passionate, and always found myself into stocks and real estate. But after seeing and working with high net worth clients for all these years, I think I've summarized it in two different client types, Harv and Maria. Harv being, hardworking business owner, go, sacrifice weekends, sacrifice evenings, reinvest everything extra he makes back in the business to build this big business. And at age 60, he sells his business for $3 million. You've got Maria, values education, learning, taking courses, maybe being a little more balanced and taking the odd time off, her family, her hobbies, friendships, keeping that more intact. And she gets to age 60 and she sells her business for $1.5 million. Now, the punchline is they both die at 63 with money in the bank. So it didn't matter that Harv had twice as much as Maria. Maria had this diverse portfolio of memories, but they both passed away. So my question to my, clients that I have that are, high net worth and older is, hey, Harv, could you have worked a little bit less, experienced a little bit more, and saved a little bit less, and then had that smaller nest egg when you're older, but it still was enough? Because a number of my clients are, they're 60, 70 years old. They're going to pass away with money in the bank. That's a given. So now you've got this big tax strategy or this big tax burden. So could you have a less of a tax burden and have lived more and saved less? And so that is something that was born into my own life of being burnt out and, 5 years of fertility struggle. And, my wife and I, it was like the business was first. Business and money came first. Family was second. And because if I couldn't get enough money, then we wouldn't have that great of a life. And I didn't see it as being an and relationship. It was either or. You either could be successful or you could have a lower income and you have, you're the best dad, you're the best husband, you're so attentive to everything. It was not both. And so again, this spending accelerator model and mindset was built out of my own struggle and for my own wife and I to give ourselves the permission to buy a new car, to give ourselves a permission to put a pool in our house, to give ourselves a permission, because you can never do that. That, like, our parents didn't do that. And that wasn't responsible to spend that money on those things. It was save. And then when you're retired, start thinking about spending. So again, that's a long answer, but it kind of gives you the backdrop of where this whole mindset, my books, my podcasts, and the teaching that we do with our clients comes from.
Dustin Service here, and it's spelled Serviviss. And you can find it at servicewealth.com. That's servicewealth.com. Dustin, I love the way you put all of that, and I love your heart behind that, and so we're going to dive into finding your spending accelerator right now. But before we actually, in just a minute, sorry, I want to take one other step back, and I want to ask you about gifts. I believe we've all been given certain gifts and strengths in this life. And these gifts have been given just to be a blessing and help to others. So perhaps go back to your high school days or your college days, right? And what gifts do you believe you were given, and how does that help how you help and bless people today?
I only maybe realizing it in the last couple of years because we ask clients about it. And the thing we ask clients about is your wealth edge. So a wealth edge is something that gives you an advantage and lowers the risk of steps that you take in your life. And so my high school years were, I was friends with the people in the smoke pit. I was not a participant of the smoke pit, but I was friends with those people. I was friends with the fighters. I was friends with the straight A student book club. I was friends with the gangsters and the cowboys. There's all these different groups and socioeconomic people, but I was friends with all of them and could mesh into different parties and could talk the language that each of those groups could talk. And I didn't realize that at the time, but being in a people business now, yes, our segment of client might be successful, high net worth people, but everyone's different. Everyone has different beliefs, everyone has different backgrounds, everyone has different risk tolerance, everyone has different political views, religious views, on and on. So how to be able to work with those demographics, I think, has enabled me to be successful and pass those tools down to the team of listening. Because if you are a good listener, it doesn't matter what groups or segment, you don't need to impress people if you're a good listener and you're helping them get what they want, because everyone's wants are different. So it's a long-winded answer, but I think it gives you a bit of color.
That's a great answer. I love it. I think it's a great, amazing gift to be able to connect authentically with anyone from anywhere in any background, and do that through listening, right? And that's a cool gift. You're right, because not everyone has that, for sure. Great. Well, let's apply that now to finding your spending accelerator. So, Dustin, what is the number one secret to finding your spending accelerator?
So the common structure that we would work with, or listener, you may have an operating company, or you might have a business, and you might have a holding company, and you might have real estate, or you might have stocks, and your business might be doing well. Back to my original conversation about the Harv and Maria at the start, is that you could be saving a lot. And so you're working evenings to weekends, you're saving a lot, and you think, is this it? Is this like my track for the next 25 years? And so the spending accelerator is a tool that we use to say, okay, you have, a recent file is a real estate agent. So this real estate agent is not in my hometown in a province over, but this real estate agent has extra money. And for easy number, let's say it's 30,000. They make let's do it easy, 720,000 a year. They spend, say, 20,000 of that for their lifestyle, and they pay some tax. I don't know if my math is even right, but let's just say they have 30,000 left. And so every year they save 360,000. And so you don't want to take any out of your corporation, because then you got to pay tax. So this is the trap that I got into in the hamster wheel, where my wife would say, hey, we NSF'd on our personal bank account. The bank is saying, hey, like, we're overdrawn. And I'll say, whoa, I don't want to take any more out of our company because we're going to pay tax on that. So I'm going to run our finances so lean that if we buy a stroller, our finances are out of whack. So starting with, you need to know what your spending is in your monthly cash flow. So step one, where do we spend our money? If you do this properly, you should be able to, at the end of the month, we're at the start of the month now, at the end of December, I probably had $400 in my checking account. So you pay yourself a certain amount at the start of the month, the middle of the month, and then it draws down over the month, and you should be really close. And maybe you could have a bigger buffer. Maybe you say it's two. I'm bad for, if there's money in the bank, I'll buy an extra set of gloves for snowmobiling or whatever. So get it so lean, but that you're still got enough to live. And so then you're not taking extra out of the company every month, because if you take extra money out of the company every month and just keep paying yourself more, you likely will spend it. And in Canada, you can leave your money in your corporation and you can invest it in there. You could buy real estate, you could buy stocks, you could buy bonds, GICs, whatever. And so leave it in there and not pay tax and let that pot of money grow. So that's step one. Know what you're spending in your personal life. Then you've got, back to my realtor example, where you've got 30,000 a month that is being saved in the corporation. So what people will say is, well, I don't know, my dad just taught me, like, save as much as you can. So I'm just saving. Where again, the spending accelerator, imagine a model, a spreadsheet, however you want to vision, and it's buckets. So here comes this 30,000 down the conveyor belt. And the first kicker, if you ever work in a factory, or, there's a kicker on the conveyor belt that kicks off stuff into a bin. And so the first bin is your emergency savings. So we're going to kick off out of that $30,000 pot, we're going to kick off 5,000. Okay. That goes into a high interest savings bucket. Next bucket over is you want to save and buy a piece of real estate. So we're going to kick off 10,000 because that's something that's important to you. So now we've kicked off another 10. We're down to 15,000 left. So keeping going down the conveyor belt, again, I'm biased. I've seen it work for lots of clients. Dividend stocks, love them or hate them. Buying good quality businesses that pay a dividend and a growing dividend. If you can buy them at the right price, it's a great diversification tool. So we're going to kick off 5,000 into that bucket. So now we've got 10,000 left. I always like a high risk bucket. This is the bucket that, you might totally screw things up and you invest in things that go to zero and lose your money. It's enough that you've got to put enough in there that if you have a win, it's going to be meaningful, but it's not enough that you're not going to get groceries on the table if you screw it up. So maybe we'll put 5,000 in there. So that's, 10 would be 35. So it's 15% maybe of your investable money. Kick that off in the high risk bucket. So now we have, 5,000 left. And so we've got 5,000 left. So you've taken care of your emergency savings. You've got, all these different buckets. The one piece that I haven't talked about yet is good insurance. So life insurance for your family. You've got 5 kids. I hope you've got life insurance, because if you're the primary income, big thumbs up. Great. So the primary income earner, if that income earner is gone, that's very bad for family. Simple analogy. Critical illness or disability, you can't work, you're still alive. Your life insurance doesn't kick in. Your income's gone and you're still around. That's equally as bad. So we might put 2,000 of that pot of money into a good insurance plan, 2,000 a month. So now we have 3,000 left. And that's out the back end of the conveyor is a bin that is, let's spend it. And yeah, let's take it out of the company and let's pay the tax and let's get it, a new car, or let's feel good spending it. And the term we use is permission granted. That money is permission granted to go on a trip, permission granted to put a pool in your house. And, and that's just kind of the real simple, I've really simplified it, because it's like, well, what do you pick in the buckets? Well, that we can get into it, but that for people is usually an aha moment. It's like, okay, if I've checked off all the boxes of being responsible and there's still money, and I can see that in 15, 20 years from now, if I just kept doing those things, that pot of assets is more than enough for us, then let's get spending it now.
Perfect. So make sure I got that. This is, I think, really, really well put, Dustin. And by the way, you can learn more about Dustin's service at servicewealth.com. That's servicewealth.com, SERVISS wealth.com. So number one, you want to know your spending, actually understand what your personal spending is on a month basis, down to maybe $400 left in your account. Number two, you want to be lean on what you actually do take out of your corporation, so that you're not just having excess sitting in your personal account. But that being said, once you figure that out and you have some good insurance in place, you're going to take that. Let's say it's $30,000 a month. That I guess is the income or the spending or whatever you're going to be taking out. you're going to be dropping that, and you have to explain that here in a minute. But 5,000 into the emergency savings, 10,000 into like a real estate fund, 5,000 in dividend paying stocks, 5,000 to high risk, right? Needs to be enough where if it actually hit, it makes a difference for you guys, not just $500 where it doesn't really make a difference. 2,000 into insurance. So I guess you have to connect those dots. And then 3,000 into spending, like, hey, go have fun and have some fulfillment and have some, all of the, you have permission to do whatever you want with that money. Is that a fair summary?
Perfect summary. Yep.
So break down that 30,000. Was that 30,000 what you're making per month in revenue? Walk us through what that 30,000 was. That your total? What was that? Walk us through what that was.
So everyone's allocation to the buckets will be different based on their goals, which I'll get into. But the analogy that I gave you was a realtor making 720.
Okay.
So in that case, 60,000 a month. Okay. They pay themselves 20. So 20 is going out for their, what we call BAM, or bare ass minimum, BAM. And the BAM is your mortgage payment, groceries, bills, that stuff. So 20 to that. You've got some money you want to leave in the operating business to like expand and whatever, and you're going to have some expenses. So in that example I gave you, is they started at 60,000, they're making a month gross. They're pulling 20, that's 40. And there was 10 left for expenses. That math is bad because there's tax to pay in there, but that's, you're trying to get to the number. Like what I ask people is, okay, for the last 3 years, how much has built up in your corporation, in the savings account? Because people often come to me and they say, hi, I met my accountant and I've got all this extra cash and I keep saying I'm going to do something with it. And it's been 3 years and I've never done anything with it. It's still in a bank account. And so I'll break it down and say, well, in the last 3 years, you've built up 300,000. Has it been about 100 grand a year? Yes. Okay. So 100 grand a year is about 8 grand a month. So, that you just are trying to find the number that a person builds up or saves comfortably on average inside their corporation.
Got it. All right. That makes sense. And then once you have that number, then you're going to go through that little the percentages that drop into those different conveyor belt buckets. You had mentioned, those numbers are not static of like 5,000 emergency, 10,000 real estate. Someone might say, I have no interest in real estate, or I have no interest in stocks. And so you could allocate more to the other buckets. Yeah, maybe a little bit different player, but the general theme is certain percentages for these different ones. I think that makes sense.
One I didn't say, just to help listener who's into real estate. One of your buckets, when you're looking at real estate and you're looking at a value add situation, and you're going to buy a piece of real estate and you're going to buy it with leverage, and you're like, I'm going to buy this house. It's a big lot. It doesn't rent for very much because it's a crap hole. But I'm going to be negative cash flow every month. But my plan is to subdivide that house into 2 lots and build 2 houses on it. So one of your kickoffs could be 2 grand a month negative cash flow. And you can feel at peace that it's like, well, negative cash is not great, but you got a vision, you put the numbers in place, and you could use one of your buckets as a mortgage payment or the supplement to cover the cost, because the rental house might not.
Yeah, you're budgeting for the negative cash flow. It makes sense. And you know that it's there. You're not just guessing that if the money is going to be there or not. I think that's the key, having the plan. Now, are these buckets different bank accounts, or how do you separate these?
That's a great question. So the emergency account and the saving for real estate would be bank accounts. The other things would be, a stock account. You have a stock account inside your corporation. Crypto, buying direct crypto, you might know this better than I haven't found a really easy way to buy raw crypto or sort of Bitcoin raw inside a corporation. Maybe that's coming, maybe it's out. I know you could buy ETFs that are tracked to the price of the crypto in a corp, and those can be effective, but not necessarily bank accounts. You've got investment accounts. Real estate is its own thing. And right now, high interest savings accounts are meaningful. They never have been in the last sort of 10 years, but we're talking in Canada, over 4% for a liquid savings account. That's that's not something you don't want to make sure you have zero money in bank account cash.
Right. If you're a U.S. citizen, can you get a Canadian bank account or no?
Well, I assume that in U.S. you could probably find a high interest U.S. bank account that's got that interest.
Just I mean, I've heard some stuff like that too, but I've heard it's usually like 3, maybe Canada's a little bit higher. I'm just curious about that. But okay, cool. That makes some sense. I'm liking it. It's making sense to me. I think listeners are hearing this, right? So I think part of it is, do you have a plan? And then do you have some kind of framework, and maybe a little bit different for others, for what percentages? But great. Okay. So what's the next secret? What's the next step, Dustin? After you've done all this, what would you say the next one is?
Well, I think looking at where the spending goes, and one of the things we talk about in sort of our framework is, maybe I'll back up. The raw framework of building a good plan is the base of the foundation of the pyramid. The widest part is having a plan. That doesn't mean you need a 100-page written financial plan. It just means having a conversation with a professional who can help quantify and gather your goals. And then from there, you've got risk management. So up the pyramid, you've got your risk management, which is what if you die? What if you get disabled? Have a will. Then in there also, that's not talked about by a lot of financial professionals, is leisure spending, solid relationships, and your personal health. So personal health, again, back to Harv and Maria that I talked about. Harv was not necessarily very healthy. Harv also wasn't very connected to his kids because he was so focused on that. So you have someone with wealth, you've got this big, great framework, but you've got a major cavity in the middle. So that's your risk management. What you put in your mind, mind nourishment. What are you putting in your mind? Who are you letting influence your mind? You're the sum total of the 5 closest people around you. If you're not aware, you're you got bad vibration, bad energy, bad whatever you want to call it, look around. Chances are you're not doing it just yourself. It's probably from the influences around you. So then the next layer up is our accumulation zone. So have a plan. Then the next layer up is risk management. Then you've got accumulation. And this is where, you would come in, or, stocks, you're starting to put your money to work. You've managed the risk. So if something happened, your money's going to be protected, and all that hard work is protected. In that one, you've got real estate, you've got saving for your kids' education, you've got retirement planning, and one other one is your mental health. So again, like the bottom in risk management, it's there, and in accumulation, it's there. Because, back to Harv, not very positive, fairly negative minded. You could have all the money in the world, and yet you're missing out on a lot of your happiness because of your mindset. So mental health is a big part of that plan. And then the legacy. So at the top of the pyramid is your legacy and how you sell or exit your business. So that is a great, we do this for our clients on an annual basis. We would look at this diagram, and everywhere there's check marks, we don't need to talk about. So if you bought your life insurance last year, if there's a check mark on there, we don't need life insurance, don't need to talk about it. We're going to talk about the exclamation marks and the questions. Questions being, I think I have disability insurance at my through my employer. Question mark, go find out. If you don't have critical illness insurance, or you don't have life insurance, or you don't have a will, and you have kids and a wife, big fat red exclamation mark. So by the end of it, we might only have a couple things to tackle, which is a lot easier than the old school 100-page financial plans that lots of people produce for clients. It's like first page, second page, get another coffee, fourth page. It's like, I'm out. And it's wrong. So we don't even build those for people. We're just looking at net worth. Is net worth increasing? Are you spending as much as you want? Perfect. Check mark.
Got it. Okay. This is real. I love the simplicity of it. The elegance. I don't think it's simple. I think it's elegant, and it's digestible, right? So you're going to have a exclamation mark for things like you don't have life insurance, go get it, right? You don't have catastrophic disability insurance, go get it, right? If you're not sure if you have it or not, question mark, go figure it out right now. And if you have it, check mark, right? And we're going to keep working through every single year. And then number 2, we're going to say, is your net worth higher or lower than it was last year? And I guess, obviously, if it's like much lower than it was last year, well, now let's dig into that and let's figure out what's going on there. Is that a fair summary, Dustin?
Yep. That's a good summary. The other piece that's not talked about was, I about 8 years ago, I went to a conference, and the lady, it was an awards conference, and it's all the rah stuff. But she came up on stage, and she got an award for something. But she said, this I'm grateful to accept this, but my breakthrough this year was not the revenue. My breakthrough this year was that I added 4 more days to my days off, and I'm up to 7 weeks off. And so that has always stuck with me, that if maybe revenue, you're kind of bogged down and you're trying to increase revenue, but you're comfortable already, start knocking days off and try and hold the revenue in the same place. So if you make 500 grand a year and that's enough for you to save and do the spending accelerator and your family's comfortable, then take off Friday and just, it's gone. So now you got to get really organized Monday to Thursday. If you can hold that revenue at 500, you've just significantly increased your status, success, whatever you have to define it to be. But your hourly wage just went through the roof.
Yeah, there's a quote like, where your treasure is, there your heart will go also, right? And if your treasure is so focused on just building the revenue or building the sales or whatever it is that you do, then that's probably where your heart's going to be, right? But if you go, look, my extra treasure is taking days off and spending time with my family and doing these things, and that's really what you're going to do is you're going to track that and look at that, right? And I would say that's where we want to be. But it's so easy to spend our time and our energy on tracking and looking at other things that you're right. At a certain point, you're like, I mean, it's funny because we have these conversations with my clients because they're, very wealthy and ultra high net worth. I'm like, at what point, how many millions much more do you need, right? Before you say, like, I'm ready to exit and be done with all of that. And that's a question that only they can answer, but we encourage them to say, well, what if, we could move this here and defer the tax there and actually increase your cash flow by 50% and lower your stress and your energy? Does that seem unreasonable for you to do? And now it goes to this control things, Dustin, because this is the way they built their wealth. So how do you help your clients overcome, releasing some of that control? That's kind of how they got there. Walk us through how you help your clients with that.
Okay. Release the control. So I like stories. So last year I helped a guy who, let's call it a construction company for easy math. So he saved, let's say, 300,000 a year. So this particular gentleman, wife was starting to step in and say, hey, you're working too much. Like, you go to work 6 days a week. You got to be on your phone at 7. You don't come home till 5:30. Classic. And he's saying, well, if I don't work, like, I'm blue collar, and if I don't work, my guys won't respect me. I need to be in first, out last, that whole thing. And so when I looked at his numbers, I asked him, well, if you only save 200,000 a year and you paid your 5 managers 20,000 extra a year, so we're going to take 100 out of your savings and we're going to put 20 grand in each one of those guys' pockets. And we're going to say to those guys, literally, this is so-and-so's Friday off bonus. I need you guys to step up so I can be more free, more creative, and this company still exists 10 years, 5 years, 3 years from now, because I'm getting burnt out. And there's lots of exciting things I want to do with you guys or women. And so here, I've just given you guys all promotions. You're now whatever you got to call them, and you've all gotten a raise. And so that is one idea to help get that person. And, if he's listening, he tried the Friday off and couldn't hold just by retraction of habits. So what I think I missed in that file was an emotional connection. So when you take Friday off, my Fridays off started with, there was a lawyer and accountant who I'm good friends with. They went mountain biking from 8 to 10. And so I thought, well, 8 to 10 is not bad. Like, getting to the office like by 11, it's not really hard work, I don't think, but I'll get up at 5 and I'll work till 7:30 and then it won't feel as bad. So I would do this. And then one day, I'm sure his name, Andrew, said, hey, do you want to come to my house? His house is just near the mountain bike park. He said, want to come to my house for coffee after? And I was like, I don't, okay. And so I didn't get to the office that day till noon, so now it's like leaked longer. And so I don't know the exact progression after that, where I just finally said to my staff, I don't work Fridays. Call me on my cell phone and I'll answer if you got pressing questions, but I likely will be in and out of my email. Not really, but I'm going to plan that day around my hobbies. This is going to be a little bit longer story than I thought when I was going to tell you, but that became Fridays off. And so Fridays off was born out of my wife and I, like to hang out. We're kind of family, at that time I wasn't as family focused. Now it's a lot better, but in a week, there's 168 hours. So 56 hours for sleep, 56 hours for work, and 56 hours for you. Now the you bucket includes your family, your self-interests, and all that thing. What usually happens with an entrepreneur hard charger is your self-interests start to dwindle. As you start to have a family, there's priorities. You want to be around your family usually, but then you don't have time for hobbies. All those things, you used to be the rock star hockey player, you used to be a good soccer player, you used to golfer, whatever your sport, dirt biker. And over the years, those things get sold out of the garage. Your hobbies start to dwindle. You might stay in shape because you do the odd workout in your basement, but fast forward to when the kids move out of the house and when you're 55, 60, your friend circle is lower. You got less friends. You're less interested in hobbies. And the only thing that really turns you crank is your work and your company. And it's hard to wrap your head around. I need to pass this business on to somebody else. I want to, pass this off to a younger person, but I can't because I'm scared as shit. If I don't come to work and that key doesn't work in the door and I'm at home, I got not as many friends. I got not as many hobbies. And I just was on a Zoom today where the guy said, I'm 65. I don't have hobbies. I love working. And I believe he does. But I just think that, that guy didn't used to be that guy before. And so the most successful clients that I see and that I look at, and, they're 80 years old. They've got good friends. They've got good hobbies that maybe they're not rock stars at anymore, but they still participate in, and they're still curious to try a new sport. And, usually that curiosity is stemmed by like maybe a few of their friends play it. So they want to be part of that. And so you've got to put that ego in your back pocket. I'm not going to be the best at this, but I've got something to talk about. I've got something to research. Some of my clients, even though we manage their money, they like to kind of follow stocks. And so it's a daily routine. They research, they read, they call me, we have a visit, they have friends that are in it. And so you're maintaining that wellness now because so to finish the story, Fridays off was my outlet to continue to do the sports and hobbies that I wanted to, but still have the weekends for the family.
Wow. There's such great wisdom there. That should be your next book. The book should start with the construction worker as the person walking through, or maybe in your story, Dustin. There's so much there. I want to unpack a couple things, right? And again, it's just elegant and it's not, but you pulled out a lot of great things, right? You're breaking down the 168 hours in the week, right? And you're saying, okay, 56, 56, 56. And you're right. As you get older, as you're in college and high school, your social days, the friends are like, it's like 100%, like it can never be higher. Right. And then you go, and then when you're still like, actually, what I found for my wife and I, we got married, we're still had a really great social life. It's when the kids start coming, right? And then as the kids start coming, you have the friends with the kids, the friends without the kids, and you still have the friends, but it starts to go lower. Then you get multiple kids. And even as you have like even 2 or 3 or 4 or 5 kids, then it's the friends with so many other kids. And the point is your time and your energy just starts to go fast. Okay. And if you're not intentional about it, you start to lose out on some really meaningful relationship with your friends, with your family, with your hobbies, right? Your other extended family, let's just say that way, right? And yeah, these are part of life, but if you're not actually segmenting and saying, okay, this entire day, I'm going to focus on personal and friends and hobbies, right? Then you're right. How else are you going to do it if you're not planning and budgeting for it? And the last part would be, you don't want to be when you're 55 or 65 and saying my whole life is my work, right? Like that's not, you don't want to be there. So I think that's so good. Dustin, thank you for sharing. We're out of time now. So we're going to go through the lightning round. Are you ready?
Yeah.
All right. Knowing what you know now, if you could go back to your 25-year-old self with one golden nugget, make sure to tell yourself to do.
I would have taken more risk.
Number 2, what's the number 1 book you've recommended the most in the past year?
Hands down, Think and Grow Rich by Napoleon Hill.
Awesome. Question number 3, what are you most curious about right now?
How to snowmobile 101 days in a season.
That's really cool. Question number 4. What's the number one leadership quote or theme that you strive to live by?
I don't know. You stumped me. My initial thought was not Morgan Freeman. It was Denzel Washington's speech, commencement speech to, I think, Philadelphia University. Look it up on YouTube. It's a great 10 minutes.
Beautiful. What's the one biggest thing in 2023, if you could knock over this year, is going to make the biggest difference in your business?
Utilization of technology and teaching staff on a whole new level. Instead of coaching staff, I'm looking at it as investing in staff for a bigger 2023.
Awesome. Last question. After all your success, helping all the people you've helped, how do you stay centered in your values, and how do you stay encouraged to charge forward to reach new heights?
I kind of described it in the number of hours in a week in balance. I think, my wife and I tried to have our own self-interests by design and be respectful of those. So if we are in a good place, then we can project that out and be in a good place for our family. It isn't family first, then yourself. So it sounds a bit selfish, but if you're kind of in tune with it, be, right in yourself, and then you can be right for others.
Beautiful. Hey, Dustin Service, I want to thank you for being on the podcast. I want to thank you for sharing so much wisdom with us. I want to encourage you to keep being friends to everyone, man. Connect with everybody, keep being your authentic self, and helping people to achieve and create wealth with planning, with mindset, with all of the stuff you share with us. For our listeners who want to get in touch with you, what's the one place that they can find you, the best place? One last time, where can they find you?
Servicewealth.com or the Picture of Wealth podcast.
Thanks, Dustin. By the way, that's SERVISS wealth.com. Thank you, Dustin. I also want to thank our listeners for listening to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy such as the Deferred Sales Trust, or getting someone like Dustin's service, is the best way for you to create and preserve more wealth, right? Whether it be exiting highly appreciated assets and having a plan, or getting right now with someone who can help you build a plan, level up your plan, simplify your plan, and so that you can create and preserve more wealth, access more freedom for yourself. If you want to learn more about how to eliminate 1031 exchange or exit your highly appreciated business or real estate, you can go to capitalgainstaxsolutions.com. We're also eliminating estate tax as well. We'd love to share with you those secrets on how that works. You can also check out the new book that's coming out. We got Kevin Harrington from Shark Tank will be in the book. It's called Building a Tax Deferred Exit Strategy. Look for that hitting Amazon real soon. Please rate, review, subscribe. Please share this with someone that could be an inspiration too. So appreciate everyone out there on YouTube, Spotify,